Yet again, I'm here to make a presentation in today's video. My name is Randolph Franklin, the lead tutor, chief executive officer, and pioneer of FCO Accountants Tuition Center. Before I get started, I want to just encourage you to ask questions in the chat box. All questions asked will be attended to depending on the availability of time, and also to encourage you to make comments in the comment section. All the comments will be taken very, very seriously. They will be used to improve our delivery. In today's video, we are looking at disposal of shares. And this video is relevant to students studying ACCA, Strategic Business Reporting, and students studying CA 3.1 under ZICA, Advanced Financial Reporting, and also students who are studying CIMA under F2, and also those students who are studying degree in accountants and doing advanced financial reporting. This is appropriate for you. In today's video, I'll discuss when control is lost, the calculation of net assets, the calculation of goodwill, the calculation of profit on disposal, and the consolidation of the financial statements. Now, when shares are sold by the parent, if control is lost, then the profit or loss for consolidation must be calculated. If control is not lost, there is no gain, no loss. It is simply a movement in equity interest. But in today's video, we are looking at where control is lost. Therefore, I will explain how the profit or loss for consolidation must be calculated. So now, let's look at the question there together. Smith Company bought 80% of the share capital of Jones, which means Smith is the parent and Jones is a subsidiary, for $324 on 1 October 2025. At that date, Jones Company's retained earnings balance stood at 180. That is the pre-acquisition retained earnings. The statements of financial position at 30th September 2086 and the summarized statement of profit or loss to that date are given below. There is no other comprehensive income, so we are given the statements. No entries have been made in the accounts for any of the following transactions. What that means is simply the cash that was received for the disposal of shares was not accounted for. And once you prepare the statement of financial position, the amount received should be reported under current assets. That's very important. It is group's policy to value the non-controlling interest at its proportionate share of the fair value of the subsidiaries' identifiable net assets. So which means the policy there, they are preparing, or rather determining, the partial goodwill. When NCI is proportionate to the net assets at the date of acquisition, that is partial goodwill. So now, what are we required to do? We are required to prepare. We are required to prepare the financial statements. But in today's video, we are only considering part A. Smith Company sells its entire holding in Jones Company for $650 on 30th September 2008. Now, since the subsidiary was sold at the reporting date for the purpose of statement of profit or loss, there was a subsidiary and it must be consolidated. But for the purpose of statement of financial position, which is prepared as at, there was no subsidiary and therefore it should not be consolidated. So now the starting point is first to determine the net assets at the date of disposal, which is the year end. So here we have workings number 1 there should be, workings number 1 should be net assets. Net assets. Net assets of Jones, which is the subsidiary. Always the net assets should be for the subsidiary. That should be at acquisition, at acquisition date, and at reporting. Reporting date, and then post-acquisition. So as usual, the net assets there will be made up of share capital. Share capital. The share capital for the subsidiary there is 180. And there 180, no change. Retained earnings, abbreviation. Retained earnings at the date of acquisition, we can check on top there. At the date of acquisition, we are given that the retained earnings was 180, which is this. So 180. And at reporting, the retained earnings for Jones was 360. So it had increased. The increase is what we call post-acquisition. So totals. So there it is 360 at acquisition. At reporting, which was the date of disposal, the net assets were 540. Then there 180. Workings number 2 should be the goodwill. So goodwill here, we have the cost of investment, which is the consideration. Cost of investment. The cost of investment we are given. The cost of investment we are given here, which is 324. Then we have NCI. NCI is based on the net assets at the date of acquisition, 360, multiplied by 0.2, because the controlling interest was 80, then the NCI is 20, which will give us 72. So total, 396. Total consideration, then less net assets at acquisition. Net assets at acquisition, which is 360. So goodwill here will be 36. So that is goodwill. Why calculate goodwill? Goodwill will be a factor in the calculation of the profit or loss on disposal of shares. So after that, now we can calculate the profit or loss on disposal of shares because control was lost. So we can move now to calculation of profit or loss on disposal. So we need to check what was the consideration. Smith company sells its entire holding in Jones for $650,000. So profit or loss, this will be workings number 3. Profit or loss. Profit or loss on disposal of shares. Profit or loss on disposal. So we have consideration or disposal proceeds. Disposal proceeds is 650. When control is lost, all the traces of the subsidiary must be eliminated. So they are now net assets at date of disposal. Net assets. It was 550, 540, but we are disposing of 80%. 80%, that will be equal to 432. Then goodwill also must go. Goodwill there is, we found 36. So total there, it is 468. So profit there will be 182. The profit there is 182. That is one method, but I'll show you another method. The other method, you can first determine what was the NCI at the date of disposal. So first calculate NCI. NCI at disposal date. NCI at disposal date there, we have NCI at acquisition. NCI at acquisition was, we calculated that was 72. Post-acquisition, NCI in post-acquisition, profits. Post-acquisition profits. This we calculated because at the year end it was 360. At the beginning it was 180. So it was 180 multiplied by 20%. This will give us how much? That will be 180 multiplied by 20 gives us 36. So total will be 108 will be the NCI at the date of disposal. This is the alternative method. So we can now calculate the profit. So take note of the 108. So now, if you are using the alternative method, you can now calculate the profit. So the profit there will be disposal proceeds. Disposal proceeds. $650. Then we have net assets. Net assets at disposal. At disposal date. That is 540. Goodwill. 36. Less NCI. NCI 108. So here we have 540 plus 36 minus 108. It gives us 468, which will be the same. The profit will be 180. Profit on disposal. So you can choose which method you want to use when calculating the profit for consolidation when control is lost. Thereafter, now you can calculate the group retained earnings because the disposal was at the year end. So now we have workings number 4 or 5. Group retained earnings. So we have the retained earnings for the parent, Smith. Smith retained earnings is 414. Then profit for consolidation. Profit for consolidation. $182. And then we have the post-acquisition. Post-acquisition profits. The post-acquisition profit there was at the year end, it was 360. On acquisition, it was 180. So the post-acquisition is 180. Since there was a subsidiary up to the year end, you claim the share 0.8. 0.8 multiplied by 180. And that will be 144. Total group retained earnings. $740. That is the total group retained earnings. So now we can consolidate. Consolidation is at the year end. So we have the P&L, there was a subsidiary up to the year end. P&L profit before. This is profit before tax. So you consolidate 153 plus 126. So how much would be that? $279. Profit on disposal. Profit on disposal we had calculated, that is 182. Tax, since there was a subsidiary throughout, the tax component will be 45 plus 36. That should be 81. So we have 274 plus 182 less 81. There is 375. Is that correct? Let me just counter check. 279 plus 182 less 81. And that is 380. It's profit for the year. The profit for the year must be distributed, attributable to the owners of the parent. Attributable to the owners of the parent. The owners of the parent. Attributable to NCI. So you must first determine NCI. NCI for the subsidiary in the P&L is based on the profit after tax for the subsidiary, which is 90, multiplied by 20%, which will be 18. 380 less 18. That will belong now to the owners of the parent. This part, students have challenges. Make sure you always start with the profit attributable to NCI, and then the balancing figure will be profit attributable to the owners of the parent. Thereafter, now you can consolidate. Okay, so now we go to statement of financial position. So we have statement of financial position. As at that date, there was no subsidiary non-current assets. It will be only for the parent 360, since there was no subsidiary. Current assets it only for the parent 360, sorry, 370. Plus the proceeds, which were not yet accounted for, 650. So we have 370 plus 650. $10.20. The goodwill is not going to be included because there is no subsidiary. $13.80. Total assets. Then we have equity. Equity and liabilities. Equity and liabilities, we have share capital there. Share capital for the parent is 540. Retained earnings, we calculated. Retained earnings, we calculated 740. Equity. Equity is 1240. 1280. Then we have current liabilities only for the parent, 100. There we have 1380, which means it has agreed or balanced. So basically that's how you go about when working out a question on disposal. For today, we'll end here. Again, we want to thank you for your support that we are receiving. For that support, may the Almighty God Jehovah bless you beyond measure. Thank you.